If you are a real estate investor, I have something you would want to listen to. I want to compare and contrast three of the biggest players in the industry as of today. I want to compare and contrast Fundrise, Sharestates, and RealCrowd. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to do Fundrise versus Sharestates versus RealCrowd. And of course, we're speaking about real estate crowdfunding. And this is basically one of the biggest investing trends today, with some especially big returns being made in the peer-to-peer real estate lending marketplace. It seems as if new real estate crowdfunding platforms are cropping up every single day, making choosing the right one a difficult job. Luckily, today I'm going to give you a few pointers, a few criteria you can use to find out which platform actually suits your investment needs. You got to ask yourself a few questions before starting. Are you an accredited investor? What's your desired time horizon? What type of property are you interested in? How much money do you want to invest in? Are you interested in debt or equity? And this is kind of important because there is a constellation of factors that will actually govern your investment decisions down the road. So for example, how much money do you want to invest in? Because minimum investment range from $0 to 50K. All right. And are you into debt or equity? As with the residential versus commercial question, some platforms offer either or both. Debt and equity investments have different sets of risk, time horizons, and tax benefits. And before you begin, you got to ask yourself a few questions also in terms of due diligence. What's the company's investment niche and strategy? How long has it been in business? Does the platform post actual documents such as title insurance and inspection reports for you to download and study? How transparent is the company? Does it provide an accounting of past deals so you could see if it performed proper due diligence? And what fees does it charge investors, and so on and so forth? This is just the list, of course, is not exhaustive, but you get the point. The whole idea is to do as much due diligence on your end before giving them your money, investing your money there. And there are 5 metrics based on our analysis. There are 5 metrics you should know before choosing a crowdfunding platform. First, you need to know the local market demographics and trends. So the local rental markets and rent comparables, the demographics and size of the population, including whether it's growing or shrinking, the outlook for job growth and diversity of jobs in the area, the local property tax rates, utility cost, property values, school district rankings, crime statistics, very important, the crime stats are key here, the projected number of units that are being built into the local pipeline, and much more. So besides the local market demographics and trends, I want you to pay attention to investment term or holding period. Very important, because holding periods should be specifically projected for each deal. You want to have this information before putting your cash in any deal. A holding period is the time that elapses between when you invest and when you have repaid your investment plus stated earnings. And the average holding period for most crowdfunding platform deals is 3 to 7 years. We've seen deals that went all the way to 10 years. Okay, so that means what? It means that your investment funds will be tied up for that amount of time. You will receive your initial investments plus interest and or equity sharing after the real estate sponsors sells or otherwise ends the deal. Number 3, the projected pro forma and net cash flow. Very important. As an equity investor in a crowdfunding deal, you can expect distributions, right? So the document should tell you how much and when to expect payouts. Typically, your payouts will come from positive cash flow. So the cash flow will be the results of rental income, that's number 1, refinancing proceeds, or income from the sale of the property. And real estate crowdfunding business plans show the expected schedule of income and expenses on a projected pro forma. You also need to acquaint yourself with something called the IRR, the internal rate of return, and the cash on cash return targets. Now, the internal rate of return, the IRR, is one of the most common metrics used in real estate crowdfunding and therefore one of the easiest to compare deal to deal. An IRR is the annual rate of earnings on an investment, and it is really typically expressed in a percentage range. For example, 13 to 15% or 20%. And the IRR is a gross number. What's more important is the projected return, typically shown as cash on cash. And this is an annualized percentage model here. This is the target investor return, net of fees and expenses. From what we've seen posted across many real estate crowdfunding sites, this number is typically around 8 to 10%. And the higher the projected IRR or cash on cash, the riskier the deal. And then you have to think about the fifth criterion here is the equity multiple. And this is another metric to use when you compare one deal to another. And the equity multiple is a ratio of your returns to paid-in capital. So the calculation is cumulative distributed returns divided by paid-in capital. That will equal equity multiple. And other things, one thing I want to say here is that like the IRR, the higher the equity multiple, the greater the projected return on your initial investment, and the greater the potential risk, right? Higher risk, higher rewards. And other things you want to consider, you have to think about whether or not capital calls may be required, what the expected exit cap rate is, how much the management and administrative fees are, the terms of the debt financing. It's very important. All right, now that we kind of clarified the basic terms and laid the foundation for what I believe will be a very productive conversation, let's first review RealCrowd. When you think about RealCrowd, I want you to think about commercial real estate crowdfunding. And we love the fact that this is a company that has been around for a while, and they've done a great job at structuring their business model. And they actually have focused on real estate funds that are focused 100% on commercial properties. Okay, the company is currently headquartered in Palo Alto, California, and they basically, you gotta have minimum $5,000 minimum investments. There are no account fees. The time commitment here is 3 years, so 36 months. You basically, so they offer debt, equity, preferred equity, and direct ownership, and they are available in all 50 states. And we love the fact that this is a company that pays a lot of attention to investor education. In other words, RealCrowd wants to educate the public about real estate investing. So the platform not only hosts a great podcast in our view, but it also offers a course designed to teach key real estate investing fundamentals. So they're not only trying to, they want your money, of course, to be able to expand their operations, but they're also, while doing that, they're also trying to educate you. And we love the fact that RealCrowd does not form intermediary LLCs, and they're not a registered broker-dealer. Therefore, it does not provide investment advice or recommendations. And they don't screen sponsors using strict criteria to ensure deal quality for their investors. And at an absolute minimum, the sponsor must have at least 10 years of principal level experience and a minimum of 50 million of transaction experience as a principal. Okay, so what they're doing here is that this is a company that is I would say outsourcing, quote unquote, outsourcing the due diligence, the depth and the breadth of due diligence to the sponsor. Okay, so this is pretty cool. And in addition to these minimums, RealCrowd will review the sponsor track record, things like bankruptcies, foreclosures, litigations, and they will also require lender references. And the average real estate sponsor on RealCrowd has over $800 million of transaction experience. Do you see that? All right. So when it comes to RealCrowd, you have the IRA option. So it's possible to invest via a self-directed IRA or a similar investment vehicle with RealCrowd. Investment liquidity terms. So it's basically from 3 to 5 years. So your money is tied up for 3 to 5 years. And on RealCrowd, you'll find both funds or specific properties offered, and there are no fees to investors. So how does the platform really work? If you have, of course, On RealCrowd, the platform, you have two parties for every investment deal. So you have sponsors, the real estate operating companies looking for funding, and investors who must be accredited. And investors are given access to inspect and browse through offerings on real estate investment deals, including all materials, due diligence, and legal documents. And the steps to getting started as an investor are relatively simple on RealCrowd. So you need to set up your free account and you start browsing deals. So once your profile is finished, you are able to begin viewing the latest investment tips and deals that are posted. You review the investment deals, so you'll find both direct property investments and fund investments. And the cool thing here is that the sponsors pay the advertising and technology licensing fees for the service, and you can choose your investment. All right. And one thing we also love here is that each commercial real estate opportunity hosted on RealCrowd falls into one of the four categories that correspond to the risk and reward inherent in the specific types of deals. So they have something called core. They also have core plus. They have value add and opportunistic. So core, the spectrum we have here is lower risk, lower return. You have core plus, you have moderate risk, moderate return. Value add, this is the medium to high risk, medium to higher return. And the opportunistic or development, this is the higher risk, higher return. Of course, the higher the risk, the higher the reward, right? That's what it is. What are the pros and cons of RealCrowd? We have the pros. Pros, they invest directly in specific properties. You have transparency and direct access. It's free. Investors are not charged asset management fees, upfront fees, carried interest fees, or any other fees. There is no 30-day cooling off period because offerings on RealCrowd are structured in a way that allows for general solicitations or public advertising. So there is no SEC imposed mandatory waiting period. You have high underwriting standards for sponsors and educational content. And what are the cons here? Accredited investors only. No secondary market. So if you invest, you are in it for the duration of the agreed to term. And you have a 30 to 60-day wait time. So opportunities on RealCrowd are not pre-funded and may not close for 30 to 60 days. So this means that you may have to wait on for may have to wait if you already put your cash in a deal. You may have to wait while your money is sitting in an escrow account and not generating any cash for you. All right, folks, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're also having a conversation about Fundrise, Sharestates, and RealCrowd. We are actually comparing and contrasting those three players, those three platforms. So I just finished reviewing RealCrowd. I want to talk now about Sharestates. So Sharestates is really crowdfunding real estate investing made simple. They're making things tremendously simple for investors. And the minimum investment is $1,000. Account fees 0 to 2%, time commitment 6 months, and they actually focus on debt equity, preferred equity, and direct ownership. They are in a series of states, actually 46 states. And what we love with Sharestates is the transparency. It's really the transparency, and they allow you to be educated. In other words, they offer the resources so you are able to know exactly what's going on a deal, on a specific deal you're in or you're interested in, or in real estate investing in general. And how does the platform works? So Sharestates provides a platform for two parties, the sponsor and the investor. I already explained the distinction between sponsors and investors, right? So a sponsor can be a real estate developer, a real estate rehabilitator, or any other non-owner occupied property investor looking for funding. You, the investor, view the investment opportunities, you pick the one you like, you read the offering materials, and you purchase your notes or membership units. So after you purchase, the cool thing here is that you can actually keep track of your investment and receive updates for the property through your investor portfolio. And one thing you can do very easily is you can link a bank account and withdraw funds when distributions are made. And you can even decide to reinvest your distributions through your investment portfolio and keep growing your investment faster. And there are two types of investments available at Sharestates. So you have debt funding and you have equity funding. So debt funding allows you to loan money to the sponsor slash developer in exchange for a percentage return, right? And right now you have the returns oscillates between 10% to 16%. So that's for debt funding. And you also have equity funding. And this comes in the form of membership units. In essence, you will own a piece of or slice of the subject property. So when you purchase a membership unit in an LLC, you are actually purchasing rights to a portion of that company. Accordingly, you'll be entitled to a share of the profits and losses attributable to that company. You can actually make a membership unit in an LLC. You can after you become a member, let's just say an equity holder, you are able to participate in the profits and losses, and you can make a profit if the project sells for more than it was worth when you paid for it. So capital appreciation, right? And speaking about capital appreciation, sometimes you have risk and rewards, right? It's clear that Sharestates is in this business for the long term, and with a focus on delivering a lower risk investments by keeping the LTV, loan to value ratio, less than 80%. We love that. We love that 80%, less than 80%, and the ratio of the loan amount to the ARV, the after repair value, below 65%. So the company is choosing intentionally to underwrite only about 2% of the deals brought to them. Okay, LTV 80%, ARV 65%. So you have a high level of filtering already. And institutions are a big slice of the current investor pool, which means individuals are investing side by side with experienced analysts who have also vetted the deals. And each deal is set up as a separate project, and transparency allows investors to know exactly what they are purchasing. Everything from contracts, title search, property information, deal information, all those things are being reviewed. Additionally, Sharestates monitors project process, including required expense sign-offs. The underwriting process and rating baseline for each project is completely transparent. So we love that. What are the pros and cons of Sharestates? So the pros, vetted by real estate professionals. So Sharestates founders have more than 30 years combined real estate experience in titles, mortgages, underwriting, etc. Unlike many other real estate crowdfunding companies where the founders are financial or technical entrepreneurs, right? We have the new fintech wave. You have the secured escrow account. So Sharestates use an FDIC insured escrow account to pull investor funds, which provides financial security. Due diligence is good because Sharestates pre-qualifies all deals using a strict underwriting process, and less than 2%, as I said earlier, of the projects they review are ultimately offered an investment opportunity on their platform. You have transparency, so you can really review all of the real estate documents associated with any project. They have short-term investments, so and you have low minimum. That's kind of cool also. And it's really, Sharestates has products that are cheaper than REITs because using proprietary technology, Sharestates Vets acquires funds and services projects more quickly and at a lower cost than banks and finance companies. So that's for the pros. What about the cons? You got to be an accredited investor because SEC requirements are pretty stringent on that. And you need to be an accredited investor to participate. And there is no secondary market. So the notes and units offered by Sharestates are restricted securities. So as an investor, you should be prepared to hold your investment until project completion. So the third player in the crowdfunding place I want to speak about today is Fundrise. And Fundrise, again, we have covered Fundrise extensively on many shows. And Fundrise is one of our favorite when it comes to investing in commercial real estate, especially passively. And the cool thing here is that they have been one of the pioneers of online real estate crowdfunding. And the company was founded around 2010. And they have actually had a lot of success over the last 10 years. And we love the fact that if you are investing with Fundrise, you basically have access to two very innovative and high yield products. So you have the E-REITs and you have the E-funds. Let's first talk about the E-REITs. So E-REITs are basically, the REITs. REITs stands for real estate investment trust. All right. And how are E-REITs different from REITs? Fundrise's E-REITs are most similar to non-traded REITs. The primary difference is in the fees. So when you invest in an E-REIT, you don't go through a broker. You buy directly from Fundrise. That allows Fundrise to reduce the fees dramatically. And there is no middleman. There's no intermediary here. So there's no upfront cost or fees. And rather than paying a front end load of say 7 to 15%, Fundrise charges a 1%, just a 1% annual asset management fee. So that's for the E-REITs. You also have the E-funds. So E-funds invest in commercial real estate. And again, this is another product that is exclusive to Fundrise. It's similar in design to a professionally managed mutual fund, but like the E-REITs, not publicly traded. So E-funds are set up as partnerships and not corporations. So they are taxed differently. So that's pretty cool. And one thing you also have to pay attention to is that Fundrise requires a minimum investment of $500. At that level, you can participate in what they call a starter portfolio. If you want to go a little higher, let's say $1,000, you can actually be upgraded to a core portfolio. There are three types of core portfolios. You have the supplemental income, you have the balanced investing, and you have the long-term growth. So speaking about those three core portfolio programs, let's just dive generally here in terms of how Fundrise does work. So when you sign up for Fundrise, you will invest either in the low minimum starter portfolio or in one of the three core portfolio plans. And again, it's $500 or $1,000. And there's no time commitment. So you'll find account fees 1%, and the regions serve all 50 states. And you make money through Fundrise two ways. You get quarterly dividend distributions, and you have an appreciation in asset value, so a capital gain at the end of the asset's investment term. Okay. Keep in mind though that Fundrise's portfolios are meant to be long-term in nature, so that it won't happen overnight. What I'm trying to say here is that there is no time commitment, but it's suggested to keep it for the long run. And one thing, so all the deals are pre-vetted and pre-funded, so that's pretty cool also. Some of the deals are pre-funded, and you can actually invest in Fundrise with pre-tax dollars and use for retirement planning. So you can use a self-directed IRA. You can also have something called the goal-based investing. There's another program. It's a new program that Fundrise has introduced recently. So you can actually invest in real estate based upon your goal, rather than types of investments or location. And you have the Fundrise IPO. So Fundrise is getting ready to sell shares in the company itself via an internet public offering. So to be eligible for this investment, you must have at least $1,000 in your Fundrise account and have selected one of the advanced plans. And you can invest up to 25% of your total account balance in this offering. So this is something you have to think about. And one thing I want to say here is that and this is just kind of close on this section, the pros and cons of Fundrise. But before I do that, if you want to redeem your shares, it's very important. If you want to redeem your shares from your Fundrise portfolio, you'll need first to submit a redemption request. And you can do this simply from your account settings on the site. So after a 60-day waiting period, you may obtain liquidity every month. Keep in mind, however, that your redemption value may be subject to a penalty of up to 3%. What are the pros and cons of a Fundrise? The pros: low minimum, low fees, no accreditation required, diversification, 90-day guarantee, commercial real estate access, passive investments, and quarterly redemptions and distributions. The cons here: investment liquidity. So Fundrise's E-REITs are not publicly traded. So once you make an investment, you're pretty much committed to the investment for the term. And you have to think about the tax consequences too, because distributions are taxed as ordinary income as opposed to the 50% tax rate on qualified dividends. All right, folks, here you have it. So I have spoken to you about Fundrise versus Sharestates versus RealCrowd. Which one should you choose? Which is the best? Which platform is the best for you? Again, it really depends on your situation. It depends on your choices. It depends on your financial situation, your investment goals, your risk profile. Very important, because real estate is one type of alternative assets. So you want to make sure that it aligns with your risk profile, whether you are a risk taker or you are risk averse. And we're showing you right now on the screen a recap table, a comparative table that gives you a synopsis of the three players. So you can see here that Fundrise, there's no accreditation required. Time commitment zero month. Minimum investment $500. They're available throughout the country, and account fees 1% per year. And the property types: commercial, residential, and single family. When you move to Sharestates, you see there that also they have the advantage of not requiring from investors to be accredited, but the time commitment is a little higher, so you have to be there at least 6 months. Minimum investment $1,000, and they are available in a couple of states. So they're available in Alaska, Arkansas. They are available in Arizona, California, Colorado, Connecticut, Washington, D.C., Delaware, Florida, Georgia, Hawaii, Iowa, Idaho, Illinois, Indiana, Kansas, Kentucky, Louisiana, Maryland, Massachusetts, Maine, Minnesota, Mississippi, Montana. They are in North Carolina, Nebraska, New Hampshire, New Jersey, and so on and so forth. Okay, and the account fees, you have a 0 to 2%. Property types: commercial, residential, single family, and they're also open to foreign investors. So this is really cool. And for RealCrowd, you have a different picture. So they require accreditation. You got to be accredited, and time commitment 36 months at least. Okay, minimum investment $5,000. They are available on all 50 states. Debt equity, very important here. And you have account fees 1% per year, and property types: commercial and residential. All right, folks, our pick, our choice, our favorite among Fundrise versus Sharestates versus RealCrowd is Fundrise. We have scored this company 10 over 10, Sharestates 8 over 10, and RealCrowd 8.5 over 10. We believe that Fundrise offers a wider constellation of offers, is available to the maximum number of investors, and they've been around for a while. They've been around for the last 10 years, and so this is just our own preference. But at the end of the day, your choice will depend, as I said earlier, about the characteristics that I just gave you in this recap table, as well as your financial situation and your investment profile. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.